Many people think that once tax day is over, the IRS is done looking at their return. But that is not how it works. In fact, the weeks after the filing deadline are often when the IRS starts taking a much closer look. Their computer systems begin comparing the information on your tax return with records sent in by banks, investment companies, payment apps, employers, and government agencies. For many older Americans, this is when unexpected problems start showing up. Some people receive letters asking about income that was never reported. Others discover they owe additional taxes they did not expect. Some are hit with penalties because the IRS believes the numbers on their return do not match the information it received from other sources. And in 2026, seniors are finding themselves affected more often than many realize. Today, we're going to break down the biggest areas the IRS is paying attention to, why retirees are getting caught off guard, and what steps you can take to avoid unpleasant surprises in the future. Let's begin with one of the most misunderstood tax rules in retirement. A lot of people believe Social Security benefits are completely tax-free. That is only partly true. Supplemental Security Income, often called SSI, is not taxable. However, regular Social Security retirement benefits, disability benefits, and survivor benefits can all become taxable depending on your income. This catches many retirees by surprise because they spent decades paying into the system and naturally assume those benefits will come back without additional taxes attached. Unfortunately, the IRS looks at things differently. The government uses a formula that combines half of your Social Security benefits with your other income sources. This includes things like pension payments, wages, investment income, retirement account withdrawals, and other taxable earnings. If that combined amount rises above certain limits, part of your Social Security benefits becomes taxable. For single filers, the key number is $25,000. For married couples filing jointly, the threshold is $32,000. Once income moves beyond those levels, the IRS can begin taxing a portion of your Social Security benefits. In some situations, as much as 85% of those benefits may be treated as taxable income. What makes this especially frustrating is that these income thresholds have barely changed over the decades. Think about how much prices, wages, and retirement benefits have increased over the last 40 years. Yet these limits have remained largely frozen in place. As a result, millions of retirees who never expected to pay taxes on Social Security are suddenly finding themselves over the line. One major reason is the cost of living increases that have been added to Social Security payments over the past few years. Those annual increases helped retirees keep up with rising prices, but they also pushed many people into higher taxable income ranges without them even realizing it. In other words, the increase in benefits may have felt like good news at first. But for some retirees, it quietly created a new tax problem. Imagine someone who spent years comfortably below the taxable threshold. Then several rounds of benefit increases arrive. Nothing dramatic changes in their daily life. They're not suddenly wealthy. They're simply receiving larger Social Security checks because of inflation adjustments. Yet those larger payments can be enough to move them into a range where the IRS starts taxing part of their benefits. That is why so many retirees are being surprised right now. The rules did not suddenly change. Instead, inflation and benefit increases pushed more people into a system that has existed for years. The problem becomes even bigger when taxes were not withheld from Social Security payments during the year. Many retirees receive their monthly benefits without any federal tax withholding at all. That means when tax season arrives, they may discover they owe money that was never set aside. For some households, that surprise can be substantial. The good news is that there is a way to reduce the chances of facing that situation again. Retirees can ask the Social Security Administration to withhold federal taxes directly from their monthly benefits. This allows a portion of each payment to go toward future tax obligations instead of leaving everything due at filing time. For many people whose income is getting close to those thresholds, taking this step can make tax season much less stressful. The important thing is understanding where you stand before another filing year passes. Many seniors do not realize they crossed the line until the IRS points it out later, and by then the surprise has already arrived. In the next section, we'll talk about a newer reporting rule that is generating thousands of IRS notices right now, especially for retirees who sold items online and never expected those transactions to create tax paperwork. Now let's move on to another issue that is catching a lot of retirees off guard in 2026. This one has nothing to do with Social Security. Instead, it involves everyday online sales. Maybe you cleaned out the garage and sold some old furniture. Maybe you listed a few household items on Facebook Marketplace. Perhaps you sold collectibles on eBay or old clothing through an online resale app. Most people see these transactions as simple personal sales. They are not thinking about taxes when they sell an old table or a used bicycle. The IRS, however, may still receive information about those transactions. Over the last few years, reporting requirements for online payment platforms have become much stricter. When certain payment thresholds are reached, companies can send tax forms directly to the IRS showing how much money flowed through your account. That means the IRS may already know about the transaction before you ever file your tax return. And this is where many taxpayers run into trouble. A retiree sells several items online and receives payments through a digital platform. Months later, a tax form arrives. The person assumes there is nothing to worry about because they sold personal property for less than they originally paid. After all, if you bought a dining room set years ago for $1,500 and later sold it for $400, you clearly did not make a profit. Financially, you lost money, but the IRS computer system does not automatically know that. What it sees is a tax form reporting payments made to your account. If your tax return does not explain those payments, the system may assume income was left off the return. That is when automated notices often get generated. Many taxpayers receive a letter months later stating that the IRS found income that appears to have been unreported. Receiving one of these notices can be alarming. Some people immediately assume they are being audited. Others panic and think they have done something wrong. In reality, the IRS computer is simply looking for an explanation. The issue is not necessarily whether you made money. The issue is whether the information reported to the IRS was properly addressed on your return. Unfortunately, many seniors are unfamiliar with these newer reporting rules. Some think the form was sent by mistake. Others put it aside and hope it goes away. Neither approach solves the problem. Ignoring IRS correspondence almost always creates a bigger headache later. The better approach is to review the information carefully and make sure the transaction is properly documented. Keeping records can be extremely helpful. If you sold personal items for less than you originally paid, documentation showing the original purchase price and the sale amount can help demonstrate that no taxable profit existed. The key point is simple. Just because money moved through a payment platform does not automatically mean you owe taxes on it. But if the IRS receives a report about the transaction, your return should properly account for it. Another area receiving increased attention involves digital assets. Even retirees who have never personally purchased cryptocurrency should pay attention here. Why? Because many people now receive digital assets from family members, investment accounts, gifts, or various online activities. The IRS has made digital asset reporting a major focus. When filing a federal tax return, taxpayers are asked questions about cryptocurrency and other digital assets. Those questions should not be ignored. Some people rush through their return and check boxes without carefully reading them. Others leave sections blank because they assume they do not apply. That can create unnecessary problems. If digital asset activity occurred during the year, the IRS expects accurate reporting. This includes situations involving sales, exchanges, payments received in digital assets, and certain transfers. The agency has invested significant resources into tracking these transactions, making this one of the areas where mistakes are more likely to attract attention. The important lesson here is that today's tax system relies heavily on automated matching. The IRS receives information from many different sources. Banks report information, investment firms report information, employers report information, payment platforms report information, and increasingly, digital asset providers report information as well. When all of those records arrive, IRS computers compare them against tax returns. If something appears to be missing, a notice may follow. That does not automatically mean fraud occurred. It does not automatically mean taxes are owed. But it does mean the IRS wants an explanation. And responding early is usually much easier than waiting until the issue grows larger. Up next, we'll discuss one of the most expensive retirement surprises of all. A financial move that can increase your taxes now and raise your Medicare costs years later, creating a costly double impact that many retirees never see coming. Now we get to one of the most important and most expensive issues affecting retirees right now. It does not feel like a tax problem at first. In fact, many people think they are making a smart financial decision when they do it. But the impact shows up later, and often in two different ways at the same time. Here's what typically happens. A retired person or couple decides to take a large withdrawal from a traditional retirement account like an IRA or 401k. The money might be used to remodel a home, pay off debt, help a family member, or simply move funds around for better financial planning. On the surface, it feels straightforward. They understand that the withdrawal will count as taxable income. So they plan for the tax bill in that year. What many people do not realize is that this single decision can trigger another cost later that has nothing to do with income tax. It affects Medicare. Medicare does not just look at your current situation. Instead, it uses your tax return from 2 years earlier to calculate what you pay today. This system is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. In simple terms, it means your Medicare premiums can go up if your income was higher than usual in a past year. So here's the problem. If you take a large IRA withdrawal in 1 year, that income shows up on your tax return. 2 years later, Medicare reviews that return and may decide you fall into a higher income bracket. And once that happens, your monthly Medicare costs can increase significantly. For some retirees, the increase is small. For others, it becomes a serious monthly expense. The standard Medicare Part B premium is already set at a fixed base amount. But IRMAA adds extra charges on top of that base premium if your income crosses certain limits. These limits are not extremely high compared to retirement withdrawals or home sale profits, which is why many people get caught off guard. A single financial decision, like withdrawing a large sum from retirement savings, can push someone into a higher Medicare cost category without them realizing it at the time. and the effect is not temporary. It can last for an entire year. So the same withdrawal that felt helpful in the moment can create a long-term monthly expense that continues well after the money has been spent. But there is another layer to this problem. That same large withdrawal can also increase how much of your Social Security benefits are taxable in that same year. So now you have two effects from one action. First, higher taxable income in the year of withdrawal. Second, higher Medicare premiums 2 years later. This is why many financial planners warn retirees to think carefully before making large one-time withdrawals. It is not just about the tax you pay today. It is about how that income affects multiple systems over time, and the impact can feel delayed, which makes it even more confusing. Someone may take a withdrawal in 2024, file their taxes in 2025, and think everything is settled. Then in 2026, they suddenly see their Medicare costs increase. At that point, the connection between the two events may not be obvious. It feels like a new charge came out of nowhere. But in reality, it was triggered by income reported years earlier. There are also situations where retirees experience what is often called a one-time income spike. This might come from selling a property, cashing out investments, or converting part of a retirement account into a Roth IRA. These events are not necessarily bad financial decisions, but they can distort your income for that year in a way that affects future Medicare costs. The important thing to understand is timing. Income today can affect taxes now and healthcare costs later. That delay is what surprises many people. And once IRMAA is triggered, it does not automatically go away immediately. It usually follows the income data from that specific year. However, there is an option for people whose situation changes. If the higher income was caused by a one-time event that will not continue, such as a property sale or unusual withdrawal, retirees can sometimes request a reduction using a specific form through Social Security. This allows the government to reconsider the premium based on updated circumstances. It is not guaranteed, but it is worth knowing about if your income changes significantly after a one-time event. The key takeaway here is simple. Retirement decisions are no longer just about taxes in 1 year. They can affect multiple systems across multiple years, including healthcare costs. Up next, we'll look at something even more concerning, how scammers are now using advanced AI tools to impersonate the IRS itself and target seniors with highly convincing fake calls and messages. Now, we need to talk about something that is not a tax bill, but it can feel like one if people fall for it. Scams targeting seniors have become far more advanced in 2026, and the IRS has specifically warned about it. The biggest change is the use of artificial intelligence. Scammers are no longer relying on poorly written emails or obvious fake phone calls. Instead, they are using AI tools that can copy real human voices with surprising accuracy. This means a phone call can sound like a real IRS agent. In some cases, it can even sound like a tax professional, or a family member. The message is usually urgent. You may be told that you owe back taxes, or that your tax return has triggered an investigation, or that you must pay immediately to avoid arrest or legal action. The goal is always the same: pressure you into acting fast without thinking. This is where many people get caught off guard. The caller may sound professional. They may use real names or badge numbers that sound legitimate. They may even know some basic personal information that makes the call feel real. But the IRS does not operate this way. The real IRS does not demand immediate payment over the phone. They do not threaten arrest in a sudden phone call, and they do not ask for payment through gift cards, wire transfers, or instant payment apps. In fact, the official process is much more slow and formal. The IRS normally contacts taxpayers through physical mail first. That means if something is wrong, you will receive a letter in the mail before any phone call ever happens. That letter gives you time to review the issue, verify it, and respond properly. Scammers rely on fear and urgency. They want people to panic before they have time to think. And AI technology has made these scams much more convincing than in the past. Because of that, it is important to slow down and verify any unexpected contact claiming to be from the IRS. If you ever receive a suspicious call, the safest action is simple. Hang up, then go directly to the official IRS website and find the real contact number yourself. Do not use any phone number given during the call. Do not follow any instructions from the caller, and do not share personal or financial information. Even if the call sounds real, it is always safer to verify independently. This single habit can prevent major financial loss. Now, before we finish, there is one more topic worth mentioning. There is currently a proposal in Congress that has gotten a lot of attention among retirees. It is often described in simple terms as a plan to remove federal taxes from Social Security benefits completely. If something like this were to pass, it would mean that Social Security income would no longer be taxed at the federal level. For many retirees, that would represent a major financial change. However, as of now, this proposal is still under discussion and has not become law. It is moving through the normal legislative process, and there is no guarantee of what the final outcome will be. That means retirees should stay informed, but not make financial decisions based on something that has not been finalized. These kinds of proposals can take time, and they often change before anything becomes official. So the best approach is to stay updated as the situation develops. To wrap everything up, here is the main picture to keep in mind. The IRS is using more automated systems to match income data from banks, platforms, and financial institutions against tax returns. Social Security benefits can become taxable when combined income rises above long-standing thresholds that have not kept up with inflation. Online sales and digital payment platforms are now reporting more information directly to the IRS, which can trigger notices if income is not properly explained. Large retirement withdrawals can create a delayed effect, increasing both taxes and Medicare costs in future years. And finally, scammers are using more advanced technology to impersonate government agencies, making it more important than ever to verify any unexpected contact. Staying aware of these changes can help avoid unnecessary stress, surprise bills, and costly mistakes. If this information helped you understand what is happening right now, make sure to stay informed going forward, because these rules and systems continue to evolve every year.